Welcome to the Daily Fortune, where we talk about the latest topics about finance and investment. But before that, please don't forget to click the like button, subscribe, and hit the notification bell so you'll know when we upload a new video. Now let's get started. Here we go again, talking about inflation. Inflation has been a major source of worry for many investors recently. For the previous 40 years or so, we haven't had to worry about it. We've managed to keep the 2% mark, which is ideal. However, a number of investors, including Michael Burry, Ray Dalio, and Charlie Munger, have cautioned that inflation could be on the way. At the end of the day, if you print out too much money, you end up with something like Venezuela, a country torn apart by inflation, Munger said, while Michael Burry remarked, #history is not useless. This text explores the 1970s American #inflation, which is more relevant today than one might think. And here's what Dalio stated. Now that the economy is rebounding, inflation pressures are rebounding. Here we got not only these investors, but also well-known investors from all across the world warning about inflation. We also received a slew of facts and statistics indicating that inflation will be a concern in the near future. We'll talk about it soon. However, the most crucial topic we'll cover is how you might profit from inflation. So are you ready? Let's get started. Remember this, you have to understand how to prepare because a lot of people are going to be wiped out. So first, let's take a look at some of the warning signs we've noticed. And the first one is something that not many people are discussing. This is all about the repercussions of all this massive money printing. When the pandemic started, many people were in desperate need of money, with little else to do. The government backtracked and distributed a large sum of free money to the people. They offered trillions of dollars to firms who were suffering from loans, struggling for emergencies, or just needed money in general. They spent hundreds of billions of dollars on tax relief for people who are unemployed. Hundreds of billions of dollars have been put into medical, and the same amount has been put into government requirements. But where did this money come from? Basically, money grew on trees, and the Federal Reserve printed it, creating something out of nothing, and all of our problems were magically fixed. If only that was true. And if producing money had no negative implications. Anyone who understands sound economic concepts knows that this isn't the case. Inflation is one of the biggest issues that arise with printing trillions of dollars. Because when you start giving people free money, demand for commodities rises. They have more money to spend. But what will happen to prices if demand rises? Of course, prices will also rise. If you keep going like this, you'll end up like Venezuela, which suffered from hyperinflation, according to Charlie Munger. However, this is simply one of the factors that's driving inflation warnings. The other factor is the world's aging population. And as we can see from the 1970s, there are far more young people than retirees. In the 1970s, there were twice as many young people as retirees in the United States. Today, the situation is the same in both categories. In the 1970s, the UK had a similar scenario, with more young people than retirees. Today, the ratio is reversed, with more retirees than young people. If you keep going through the developed economies, you will find that they all tell the same story. When it comes to the number of people of working age, all of these strong economies are dropping. It is somewhat declining rather than growing. The story is the same in developed countries. It's the same story throughout Eastern Europe. The only exception is Africa, which is one of the poorest continents in the world. This decline is significant because if you have a body less than capable of working, you will have less supply. It means you'll be able to produce only fewer items. As a result, the cost of labor will rise. Businesses that hire labor now pass these costs on their customers. They raise the price of goods and services, which is known as inflation. These are some of the variables to be aware of, as they may contribute to future high inflation. However, the fundamental question is, how can we profit from inflation or avoid losing money? Because maybe most of us have never experienced dealing with such high levels of inflation. Inflation was last seen in the 1980s, and most people don't know how to invest during that time. We're not used to seeing the currency depreciate, bonds and some equities being destroyed, and other asset costs being eaten away by inflation. one of the better options to consider and pursue is by purchasing real estate. And in order to buy real estate, we've gotten ourselves into a lot of debt, maybe $750,000 in debt. So let me show you how this works mathematically. So the worst asset type to be in during an inflationary economy is cash, because your dollars will obviously depreciate in value. What is the polar opposite of cash? It's all about debt, inflation. Instead of eating away your cash, it eats away your debts. This is one of the advantages of real estate. But because of inflation, the value of your home rises. Inflation increases the cost of everything, including housing. That's another advantage for real estate. However, your rental income grows in sync with inflation, which is a plus, another positive. So if you invest in real estate, your debt will be eaten away, making it less of a burden. But 2, the value of your home will increase. And 3, your rental payment will increase. So, with this investment, you can profit in a variety of ways. And if done correctly, you can possibly make a lot of money. You can now either buy real estate directly, or if you don't have the funds, invest in an REIT, a real estate investment trust, which will invest in real estate for you at a reduced cost. Sounds good, right? Moving on, real estate is not the only asset that can be profitable during inflationary times. Gold is another asset that does well in this environment. As a result, during inflationary periods, investors see cash's value plummet and no one wants to hold cash. And investors try to think of an asset class that retains its worth, has limited quantity, and cannot be devalued. Gold is, of course, one of the options. So when investors begin to see inflation, they rush to gold, which rises in price. And if you look through history, you'll notice something similar. From 1970 to 1980, there was a period of high inflation. It was extremely high here, ranging from 5% to nearly 15%. What happens to gold during these periods is that its price shoots up like a rocket, from roughly $250 to over $2,000. That's a huge difference. Therefore, gold is a good asset to have during periods of rising inflation, but you should buy it while it's still inexpensive. Another thing that investors are expected to run into when inflation rises is cryptocurrencies such as Bitcoin. I know a lot of people will be against it, and there's no history to back it up, because Bitcoin has only been around for 10 years, but there is logic to it. Allow me to explain. As a result of inflation, the value of your dollar is depreciating. That was something I mentioned earlier. You can't water down Bitcoin now since there are only a set amount of them in the system. There are only 21 million of them available. As a result of your dollar's depreciation and watering down, people are flocking to other currencies. Bitcoin is one of them. There's no guarantee and there's no evidence to back this up, but I believe there's a good chance Bitcoin will take off if we see hyperinflation. So there you have it. We have real estate, gold, and Bitcoin. These are investments that will do well in a rising inflationary scenario. Another item to consider is the stocks that do well in this market, because there are some who don't. To demonstrate this, we'll use Warren Buffett's example, the greatest investor of all time and his entire law about stocks and inflation in the past. When it comes to high inflationary times, you should concentrate on stocks that have 3 important characteristics. One is the ability to create money rather than consume it. The second one is that companies can readily raise prices in sync with inflation. The third one is to purchase companies that can accommodate bigger dollar volume growth in business with only minor additional capital investment. Inflationary times should make stocks like Coca-Cola, Buffett's long-term investment, feel the best. They have the ability to raise prices as inflation rises. There are companies that can generate a lot of cash flow, such as Sanderson Farms, which can easily raise chicken prices in line with inflation while still generating a lot of cash flow. So if we're going to experience big inflation in the future, you'll want to favor these types of companies more. Don't get me wrong, when inflation is high, it may be a very stressful moment for your finances. Hyperinflation can take virtually your entire life savings, without the government having to bother raising the official tax rate at all, as Thomas Sowell put it. But it doesn't have to be this way. Inflation does not have to take your money away if you invest wisely. In fact, you can earn while the majority loses by making intelligent investments in the correct kind of stocks: gold, real estate, and Bitcoin. Thank you for watching. So that's it for today. I hope you learned something from today's video, and to get updated with the next videos, don't forget to hit the notification bell. See you next time.